Leveraging golden principles to help you with your investment properties.
Right, so basically today we're going to talk about DSCR, we're going to talk about the golden rules of 50%, 1%. We got a lot of things to talk about in this one, but really we want to talk about at the first is investment loans are typically going to have higher interest rates than a home where someone's going to be the owner occupancy because they are inherently riskier. Because at the end of the day, if you're losing everything and all your businesses are going bad, what are you going to pay first? You're going to pay your own house that you live in first before you pay the houses of others. So they are by nature riskier for banks. They do them all the time, but just understand that it has a higher interest rate because it's a higher risk.
Exactly. And usually our depends on the market, is like a 1 to 1.5% more expensive than the interest rate that the people getting for their first home.
Right, so if it's 6.5 right now, the typical investment loan we're seeing is going to be 8% at the filming of this video. Now, when we see them all the time on the back end, and this is we're talking about 30-year fixed, and it can be the exact same house that people are buying, but the mortgage payments are going to be different because an investor is looking at it with a different profitability in mind.
Exactly. Therefore, now we wanted to talk about understanding the power of the leverage. What is the leverage here?
Basically understanding the financial instruments and financial tools that we can do for borrowing capital to increase our returns on investment. There's a calculation that we're going to talk about of total investment by the actual investment cost. I think the best thing to do is talk by example with this one.
Exactly. Therefore, let's say a very simple example. You're purchasing a property with the price of $200,000, and the bank or that institution asks you for investment at least 20%. Usually they say 15 to 25%, but let's, for the sake of the argue, 20%, which brings us to $40,000 for the down payment, which means you are getting $160,000 loan. And this one, the leveraging of us is 5 to 1. Why? Because it's $200,000 basically that property, and you pay $40,000 down payment, and this is 5 to 1 ratio.
Now, however, here's where things get interesting, because if this property value goes up to 220, right? So let's just say the property value increases, appreciation happens, everything's happening. So your actual equity value has now gone up 20%. So you have $20,000 that you can now use in equity, which is a 50% return on your invested capital, which is much higher than that 10% that we were thinking.
Okay, therefore we got 50%, and the reason is we got that $20,000 appreciation on the property value.
Just to have things to think about. Now let's talk about the CapEx.
CapEx.
What is CapEx?
CapEx is a fancy word for capital expenditure reserve, which is what is the
Basically,
CapEx?
we should have a plan of action and a system, a bank set up to where we're going to have all this money for future repairs and improvements to the rental property going into this fund. This is not the same as minor repairs, maintenance. We're talking about the big ticket items. We're talking about HVAC. We're talking roofs. We're talking about things that will extend the life of the property. So just, you want to give an example for this?
Exactly. Let's say a rental property, again, worth $200,000.
Simple math.
And you might save annually 1% to put for the repair of the house, which in this case 1% is equal to $2,000 for CapEx. Now this fund really could help you to cover for the new roof or AC unit or anything that helps you.
All your major repairs.
Repairs.
Not minor repairs,
okay.
Major repairs. Okay, the next thing we're talking
without affecting basically your cash flow negatively, since you have been budgeting them from the start when you purchased the investment property.
So let's do our introduction, then we'll talk about loans, right? So let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now let's talk about the debt service ratio, the DSCR loan, which is the most common loan that we see as real estate agents when people are going to talk about investment loans. So what is a DSCR?
Exactly. DSCR is debt service coverage ratio.
What does it measure?
Basically measure the cash flow that is available to pay the current debt obligation.
Now, basically, lenders are going to do a calculation based on what the property's value is. They're going to have viability and the net operating expenses divided by total debt services. We're going to give you an example of this because this is the most common loan we see when people are talking. This is the bank statement loan. This is the loan people use to buy investment properties all the time. And again, we talked about higher interest rate already.
Exactly. Therefore, let's make an example.
Right.
Suppose your rental income after the expenses, but before the mortgage is $1,200 per month, no? And therefore, for 12 months, you're really talking about annually of $14,400, and your annual dip, including principal, interest, and any financing cost like a taxes, is $12,000. Therefore, you had gross income of $14,400. Now you have all this basically that you need to pay $12,000.
Now this is going to be a DSCR of 1.2, 14,400 divided by 12,000. This is going to be a good number for the bank, and it's a lower risk for your lender. People are going to like these type of numbers, and you're more likely to get approved for the loan at that situation.
Therefore, this DSCR 1.2 is going to be a good indication and less risk for the lender.
Absolutely. Let's talk about taxes. Taxes.
Therefore, tax implication and depreciation. Therefore, you definitely can use the tax benefits such as depreciation, which is not a non-cash expenses, no? And that can reduce the taxable income.
So tax laws you allowed to take 27 and a half years of depreciation on a property. Most people are going to sell it before that point, but you are allowed 27 and a half years to deduct money for this home. So if you purchase a rental property at $275,000, and that's not including the land, which is typically 20%, you can depreciate $250,000 of this investment. This allows for an annual depreciation value of $9,090 is going to reduce your tax liability by owning this home.
Exactly. Therefore, this is one of the things that you need to pay attention. The next thing is advanced budgeting, which is like it could be a golden rule for you, and they call it 50% rule and the 1% rule. What is that?
Now, the 50% is a little hard in 2024 to accomplish. It still happens, but it's a harder one to follow because it just means that you'd had more income to invest up front. Basically, it's saying that half of your rental income is going towards expenses, not including the mortgage. So you want to make sure that you're making a certain amount of money, and then this money is you're not just pocketing the money and putting it in your pocket and going on vacation. We're taking 50% of the profits and putting it into expenses.
Exactly. Now we wanted to make an example for that to be very clear.
Well, don't you want to know about the 1%?
I'm sorry? Okay, what is the 1%?
And the 1% rule ensures that a property's monthly rent should at least be 1% of the price of the home. So if you bought a home for $300,000, you want to try to have a rent for $3,000. And if there's no rent in that area for $3,000, maybe that 1% isn't the best deal for you out there.
Which is like it's similar to like an ROI 10%.
Right. So you want to make sure that you're getting 1% of the value of what you paid for that home.
That would be really good if you do that. But let's say
those are the rules.
You have
the golden rules.
The home cost for you $200,000, and you could follow this 1% rule, and you rent it out for $2,000 per month. And by applying the 50% rule, what's going to happen? You receive $2,000 per month in rent, but you expect to spend $1,000 of it because it's 50%. For non-mortgage expenses, no?
Right, so that's your HVAC and things of that sort. These are basically formulas that investors use all the time to understand if the single-family home is a good financial value for them. And that's why we made this video for you, so you could really see what we're talking about when people ask us what DSCR and is this a good deal. Things that we talk about with them. When people ask me, I want to buy investment property, we have a lot to talk about.
Exactly.
So if you like this video, please watch this video because we go into more detail about things. And then also, please go to
alandvictoria.com and please call us. We'd love to help you as a real estate agent and talk to you soon.